Howdy, Jacob here. Today we're looking at ADT in the diversified consumer services industry. This is a pretty well-known security, both residential and small business customers around the United States. Growth has been very, very good from 2014 to 2023, but there was likely some acquisitions to get to 2017, where the growth has actually been 4.3 billion to 4.9 billion, really looking at like a 3% CAGR over that 7 year period. So nothing super impressive. Gross margin, though, you're looking way higher margins here, both on the operating and gross side. Return on invested capital, very poor, which is a little bit surprising, I guess. So they're really not historically getting a great return on the money reinvested back in the business. So companies like that, it might make the most sense to not reinvest and really just give money back to the shareholders through share purchases and dividends. The balance sheet shows 15 million cash on hand with 321 million short-term debt and 7.6 billion long-term debt. So their debt has been reduced substantially from 2017 to 2023, about almost 3 billion. Looking at about $2.6 billion reduction, but they have no cash on hand. Again, I bring this example up to do just a quick comparison in your head. This isn't just end all be all, but it's a simple comparison of saying, let's say you have a $15,000 in your bank account and you have 7.5 billion debt due over the long term. Again, that long term could be anything over a year. So it could be a mortgage. If you're making 500K a year, 600K a year, and that 7.5 billion is due over the span. I mean, okay, that's not even very reasonable. Let's say you're making 750K a year and you have 7.5 billion on your house due over the next 30 years. It might not be as concerning, but if this is due in 2, 3, 4, 5 years, that's a concern. You have to see what they're really making to see if that makes sense for you. And for them, they're making about, what are you looking at? 5 year average basis, maybe $1.5 billion. And that's about, was that 5 times their 5 year average free cash flow? Again, it's not terribly concerning. I do think that 5 times your 5 year average free cash flow is a fairly reasonable number. But I mean, if this debt is due in 2, 3 years, they're going to have to refinance it. And if no one's willing to refinance, you're going to have to sell off some things. And they don't have, a whole lot to sell off. They have 4.9 billion in goodwill, which is intangible, and then other intangible assets of 4.9 billion. So there's not really a whole lot for them to sell off that's truly tangible. They might have to sell things for 50 cents on the dollar or a couple cents on the dollar, which is definitely not ideal, which is the problem with debt and over levering and not having the cash reserve, especially for a business that makes you comfortable. And for me, there's not a whole lot of cash here. I would be a little bit concerned with this business, even though their debt, long-term debt, is about 5 times their 5 year average free cash flow. It just is a lot for not a lot of cash on hand. So really, I would think their use of cash is just going to be paying down this debt. They're not going to be making a lot of acquisitions, buying back shares, paying a dividend that's that big. This 129 million dividend in relation to their 5 year average free cash flow is less than 10%. So really no concern there, but they're really leaving a lot of money to pay down this debt, which you can see $2 billion paid in 2023. And they had to sell off. They did devastation here too to help fund some of that. So, I mean, it's tough to really be confident in the business reinvesting and thinking about growing when they're really gonna have to focus on that debt reduction. Personally, so I think I'm ready to start making some assumptions here. It's long ramblings, but I hope you get the gist of what I'm saying. And that even if you're looking at a business, you should think about it similar to how you would view an individual. And does that risk, make up for it? So you're going to have to either make conservative assumptions that take that into consideration, or your discount rate is really going to have to shoot up to make you feel if you get a 50% return over the next 7 years, I mean, yeah, the risk might be worth it. But if you're getting, no margin of safety and you could buy the same company essentially all else equal with no debt, obviously you'd be more comfortable doing that. And so this is where your margin of safety and your personal perspective is really going to have to come into consideration. But for me, revenue growth, probably 3%, I think is pretty reasonable. I do think that they're a pretty well-known company. I don't think their margins really show it, and their everything, all the figures are really showing it. But I mean, I do think a lot of people know ADT in the security industry. They just do 5 and 6%. I feel pretty comfortable with their dividend keeping the same. I'm comfortable with that. They haven't really increased that much. Share change. They haven't really bought back a lot of shares. Maybe they buy enough to offset stock-based compensation. So let's keep that flat. And we're saying the company needs to fall 62% to get the return I'm looking for. Again, this is not the price I'm necessarily buying it at. This is just a preliminary review based on the numbers. Please do your own analysis and take into consideration the debt. I do think that that could be a concern. Look when it's due. Is it due so soon where it's going to be a problem, or is it due so long in the future that really there's no issue? I do think that you really have to balance out what your perspective is and what your risk tolerance is. I do hope you enjoy the video. Have a great rest of your day.